one of the ideas for Rebel Capitalist Pro is just to set up a portfolio with $100,000. So if I, George Gammon, had $100,000 in an account, here is what I would do as of right now. And here are the adjustments that I would make, the buying, the selling in real time. I talked about this probably a year ago, and I just haven't had time to do it. But now I do have time to do it. So that's what this is all about. We're going to set up a real-time portfolio within Rebel Capitalist Pro. So if you want to check that out, yeah, it looks like Josh just put up the link there, or you can just go to georgegammon.com/pro and check it out. But this is going to be the first purchase that I am making with the account that Josh just set up for me at Interactive Brokers with $100,000. We're just going to walk through it in real time, and I'm going to try to explain my rationale for the purchase to the best of my ability. And then I'm going to pitch you. I'm going to try to sell you on going over and checking out Rebel Capitalist Pro, because you're going to get a ton more of this information, and from people who are a hell of a lot smarter than I am. People like Lynn Alden, Chris McIntosh, Brent Johnson, Tony Greer, Patrick Sresna, Jason Hartman, etc. But let's dive into it. This is going to be a lot of fun. So we've got Josh on here, and I'm actually not moving the arrow. This is all Josh, and I'm going to go ahead and actually, Josh, let's do this. So let's go ahead and go over to the odds of the Fed raising rates, so I can explain kind of my rationale to the viewers who are on here. So Josh and I did some research this morning, and we saw that the next Fed funds meeting is July 27th, or that's the next time that they're going to announce a potential rate hike. So we saw the odds of this for a 50 basis point hike. Right now, the market is pricing in 100% of at least 50 basis points. They're also pricing in a 83% chance of a 75 basis point hike and a 0% chance of anything less than 50 or pretty much 100 basis points. So then we move on to September of 2021, which I think it gets really interesting, because let's just assume for a moment that the Fed raises 75 basis points. That would take them from 150 up to 225 or 2.25, which is where they got to last time when they were raising rates. And you guys know that every single time since 1981, they've gone into a rate hiking cycle. They've never got back up to the high water mark. Why? Because the debt expands. And if you increase the interest rates in the real economy, this creates a recession, an economic downturn. Now, I think this time it is a little bit different, because the Fed is trying to battle inflation, where before they were not. They were just there to support the markets, and regardless of what they say, and bring down the rate of unemployment. But this time it makes sense that they have already taken rates higher in the real economy, or rates are already higher, I should say, in the real economy than they were back in 2018-19 when they went through the last rate hiking cycle. And this is something that my good buddy Joseph Wang brought to my attention at Rebel Capitalist Live. So now if they go to 225, they'll get back up to where they were. But again, the interest rates in the real economy will be far higher than they were during the last rate hiking cycle. So then we move to September 21, and that's the next Fed meeting, or the next time that they could potentially, I guess they could raise rates at any time, but this is the next scheduled meeting where they're most likely going to raise rates according to these odds. So think about this. We're at 225, and going into 2021, there's a 100% chance that they hike by at least 100 basis points. 100%. That's what the market is pricing in right now. So you can assume, to a certain degree, this is what the bond market is pricing in at the, I guess, the long end and the short end. But what I'm most concerned with is the 1 year and the 2 year. because this is what this, especially the 1 year, is more impacted or impacted to a higher degree by Fed funds than maybe the long end. So the market is predicting a 100% chance of at least 100 basis points. So that would take interest rates to 3.25%. And then there's an 84% chance of 125, which would take rates to 3.5. And then a 4% chance of 150. And by the way, I didn't even notice this part. Look, Josh, down from 26.9% as of last week, which would have taken rates to what, 375? I mean, how does this now? I get it. The Fed is trying to fight inflation. And going back to my good buddy Joseph Wang, he is under the his base case is the Fed continues to raise rates even if they are creating a recession, even if they're breaking the market or the economy. And he just thinks that in order to make sure things don't get out of hand, they're going to take any, let's say, they're going to try to backstop the credit markets with their balance sheet. So I know that's nerdy, esoteric, kind of wonky speak, but what that means is they're going to continue to raise rates. And if something breaks in the credit markets, like corporate debt explodes to like 20%, then while they're raising rates, they're going to come in and buy corporate debt to bring those rates back down to a level that is, let's just say, tolerable with these corporations in the United States who have to roll over the debt. So this, I think, is probably the best argument for the Fed increasing rates. But there again, it depends on the CPI. I think if CPI is going from 8.6 down to, let's say, 7, down to 6, I think even if it's trending lower, it's going to give them the out to, yes, maybe continue to raise rates, but not at 100 basis points a pop. And if the market is factoring 100 basis points, looking at September 21, 100% chance, okay, what if we get a 50%? Then that means that the rates in the rest of the bond market, especially the 1 year, would probably decrease, right? So I think, and also let's remember, in my opinion, if the higher they raise rates, which would be the lower the price goes of the 1 year treasury, let's say, I think the higher the odds are that they end up decreasing rates within the next year. Because think about this. Let's take it to an extreme. What if the Fed increased rate? Let's say I bought the 1 year treasuries today, which I most likely will here. That's kind of let the cat out of the bag here. But so you buy a 1 year treasury today at, let's say the interest rate is 2.9%. Okay. So then the Fed comes out and surprises the market in July, and they increase rates by, let's say, 2%. Holy cow. Then the 2 year most likely screams higher, the yield, which means the price of the bonds that I just purchased goes down. But by doing so, what would your assessment be of the chances that we get a recession sooner than later, or if we are in a recession, that this recession is exacerbated? I mean, take it to a further extreme. Why don't they raise 10%? Okay, great. So initially, the price of your bond plummets, but then the probability of them taking rates back down to zero increases exponentially within the next year, which would be the time frame that you have to maturity. So taking this one step further, look, you guys know darn well that I'm very bullish on commodities long term. Not so much in the near term. Don't really have an opinion. I definitely see how they could go down significantly if we go into a recession. maybe not oil to the same degree, but copper, iron ore, a lot of the things that I would like to buy, coal especially, maybe even uranium. So I am holding a significant amount of dry powder. Well, right now if my expenses are denominated in dollars, which thank goodness they're not, at least most of them, I would be losing 8.6% at a minimum of my purchasing power per year for holding that dry powder position. Okay. Well, 3% is better, or getting 3% is better than getting 0%, even if the 3% still has a negative real interest rate of, call it 6%. Just to, losing 6% is better than losing 9%. So if I'm going to hold on to my dry powder until commodities get cheap, if the Fed is continuing to raise rates, that means that most likely inflation is still running hot, or at least it's not trending down to a point where they'd like it. So if they're continuing to raise rates, which means I'm taking a loss on the 1-year treasuries, most likely commodities aren't at a price where I would want to buy them anyway. So what happens if we live in a world where the commodity prices get super cheap to where I would want to buy them? That's most likely an economic environment where the Fed is lowering rates, not raising them. So to me, this is kind of a no-brainer, and I'm sure I'll probably be wrong here. But it seems like if I want to buy, if commodities get to a level where I want to buy them within the next year, then there's a very high probability that the price of a 1-year treasury will be a lot higher. In other words, the yield will be a lot lower than it is today, even if yields go up over the next, let's say, 3 to 4 months. And who cares if they go up, because I wouldn't want to use that dry powder to buy any commodities, because most likely the commodity prices wouldn't be down far enough, because interest rates going up would imply that the CPI has not yet come down to an acceptable level by the Federal Reserve. So hopefully that makes sense. Let's look at a worst case scenario. A worst case scenario is that the interest rates continue to increase, and they increase for the next year. Okay, well, in that world, again, most likely commodity prices don't come down to a level where I would consider them cheap. They may come down, but not to a level that would entice me to buy them, at least not with a significant degree of my portfolio. And at the end of 11 months or whatever, then the bonds mature. You get your principal back, plus, let's call it 3%. No harm, no foul. I would have had that money in a bank account, basically collecting 0% anyway. So to me, this seems like a pretty good asymmetric play for the dry powder I want to use to hopefully buy commodities at a much lower price within the next year or so. That said, okay, Josh, now let's go over, I think I've hopefully explained that clearly.
Also, it seems like these rate hikes are cumulative, not they're not going to do 100 basis point hike in September. It's just going to be accumulative.
Okay. Yeah. Thank you for clarifying that. I think maybe someone was pointing that out
in the chat. They let us know very, very quickly.
Oh, good. Thank you, guys. I appreciate that. So my numbers were off. Concept, still the exact same. And even if the odds weren't as high for a rate hike in September, it's still the latter part of the concept remains the same. And that is that if commodity prices are to go down to a level where I would want to buy, most likely the 1-year treasury is not trading at 3%. It's most likely trading a lot lower. Therefore, when you went to sell those 1-year treasury bonds in order to have the dollars to buy the commodities, you would be selling them at a much higher price. And the worst case scenario is you just wait, do nothing. The Fed continues to raise rates, but yet that would mean the CPI is higher, and that would most likely mean that commodity prices have not come down to a level where I would want to buy them yet for the long term, meaning the next 10 to 15 years, with this commodity super cycle. Okay, so now let's go back to the transaction here, Josh. And so the next step here that I want to walk you guys through is the 10-80-10 portfolio. And so a lot of people say, George, if you had $20,000, you know, how would you invest it? 100,000, a million, you know, 10 million, whatever. It's all the same. It doesn't matter if I had 20,000 to invest or 20 million or 20 billion. It's still going to be the same way. I'm just going to do this 10-80-10 portfolio. It's not right for everybody, but for me, it helps me achieve my main objective, which is maintaining my purchasing power. And I think we're going into a very tumultuous economic environment, to say the least, over the next 2 or 3 years. So for me, my priority is not just maintain. What's the saying they have? My priority is capital preservation as opposed to capital appreciation. And for that reason, I like to set up this 10-80-10. So for those of you who are not familiar, that would be 10% insurance, which for me is just physical gold. Then 80% would be investments. Now, I define investments as something that pays you to own it. So whether that's positive cash flowing real estate, whether that's dividend paying stocks like producers, underlying asset being commodities, maybe it's bonds. In fact, I was listening to my good friend Adam Taggart today on Wealthion, and he was interviewing a gentleman that was talking about bonds for U.S. Steel being at like 9 or 10%. Might be interesting, right? Depending on the maturity there. So that's an example of stuff that pays you to own it. So I want that. I want those assets to amount to 80% roughly of the portfolio. Main reason there is because that is really hedging my downside with the rest of the portfolio, because I'm getting that cash flow. I mean, that's the biggest reason there. So if I do make a mistake, or you know, if the paper value of an asset goes down, okay, well, it's being subsidized by the cash flow. If you're losing a little purchasing power in your dry powder position, okay, fine. I'm being subsidized by the rest of my portfolio. So you kind of keep it simple, stupid. So then the other 10% is what I would call speculative assets, which isn't really a derogatory term when I'm using it. It's really just to say that there's an asset that has good asymmetry, might be cheap, might be panic. Maybe it's trading under the cost of production, and but it might not be paying you to own it. And uranium would be a great example of that. So what we're going to do first here with the 100,000, I'm going to break it down into those buckets. You know, so 10,000 is going to go to gold, 10,000 is going to go to speculative assets. But I'm not ready to pull the trigger on anything with the 80,000 right now. So what I'm going to do is I'm going to have Josh go ahead and pull the trigger on buying $50,000 worth of these 1-year T-bills. Now, on Interactive Brokers here, Josh, actually, do you want to explain what we're going to buy here? Explain how we're going to buy the T-bills, or the 1-year T-bills that were issued back on, I believe, June
16th. Yeah,
16th.
so you're buying the June 16th contract of a 1 year from the auction, and it expires June 15th, 2023. Basically, per T-bill, it's going to cost you $973, and you're going to buy 50 of them, which is just about $50,000.
Well, yeah, okay. So got it. And just to be clear, I don't know that's a contract, that you're actually buying the T-bills themselves. I think Josh is too used to options.
yeah. Sorry, I was not paying attention there. So do you want me to pull the trigger?
Yeah. So go ahead, and what's the price, right? Or what's the
I just did
it doesn't really matter. Just go ahead and buy it. Okay. So, and guys, obviously I'm not too savvy here on Interactive Brokers. And while Josh is doing this, just one of the reasons we set up this IB account to do this kind of over the shoulder investing type thing that I'll be doing in Rebel Capital Live moving forward is every single pro that I talk to uses Interactive Brokers, and I know they give you access to a lot more international markets. So I've never used it, so that's why I had Josh set it up for this specific project.
Well, I've never used it either.
Oh, okay. Well, great. We got the blind leading the blind here. All right. So did you go ahead and
Yeah,
so
the order's been submitted, so you'll get filled probably pretty soon.
Okay. So
yeah. So you have not yet been filled, but you just
Okay.
put the order in.
Okay. So
That was pretty anticlimactic, but you're pretty much done.
okay. Well, there you go, guys. All right. So we just bought $50,000 or almost 48.49 basically. And so why did I do that? Why didn't I do it with all $80,000, which would have been the 80%? Because I'm just diversifying. And again, I'm not trying to get rich here. My main objective is to stay rich. And I don't mean that in a braggy way. I'm just using that as a a common phrase, investing way to describe it in the investment world. And what I mean by that is my main focus isn't capital appreciation, it's capital preservation. That's what I mean by that saying that is common within the space. So just keeping 30,000 of the 80 in actual cash in case, who knows, we get a panic situation in something that I want to buy. And then I'll have the cash there to go ahead and take advantage of that. Just be clear, when I'm talking about the 10-80-10 portfolio, this actually excludes the cash position in the portfolio when I'm kind of describing it on my live streams within Rebel Capitalist Pro. But right now, don't have anything else for the 30. So we're just going to keep that. We're going to pretend that's part of my investable assets. And we're just leaving that to be able to pull the trigger on another opportunity in the interim that I don't see right now. We got a black swan. Who knows what happens when usually that 30 would be just in another bucket of the dry powder. But we're just doing this exclusively for this example. So if you guys want to follow the journey of investing the rest of the $100,000, or maybe when I might sell the 50 that we just bought in order to parlay that into commodity producers, and then what commodity producers I might buy, and then what we'll do with the 10% that's speculative, with the 10% that's insurance. You guys already know what I'm going to do with that. I'm going to buy gold. Now, will I buy physical? Will I buy the Sprott PHYS? Maybe a little silver. I don't know. For that, you're going to have to tune in and go to Rebel Capitalist Pro and check it out. And right now, there's an introductory offer where you can get a week trial, $1. You cannot beat it. And we're setting up that portfolio right now in Rebel Capitalist Pro, where you'll be able to track the journey, track my progress, see if I make money, lose money. Who knows what will happen, but it'll be very exciting. And it will be a fantastic learning experience. I was listening to a podcast yesterday with someone that I really admire, Mark Yusko. And he has a saying. He says, you either, it's not, actually, you know what? I'm going to look it up because I think it's I want to get this right because it was very profound. He said, with every investment, we become richer or wiser, but never both. I think that is incredibly wise words from Mr. Mark Yusko. So you can see me get richer or wiser by going to Rebel Capitalist Pro right now at georgegammon.com/pro.